Good day to one and all. This is Dr. Sivaram of iknowindices.com. Once a month, I give this tracking the live Forex market together in two parts. So in the month of September, today we are on 21st of September, I'll be giving part one of tracking live the Forex market together webinar between 8 and 10:50 GMT. Why such a long time? So this webinar, I am going to track the market live using the live market code page and the GMT time frame, and also we will try to find out what sort of moves the players are making in the market. So I will explain to you based on the time frame they are taking to make the moves above that of the initial high or below that of the initial low. We'll be able to identify whether they are making a quick move or a slow move. Thereby, it will give the reading for us. That is, we'll be able to identify what the intention of the player is. Based on that, we will try to plan our trades and try to participate in the market, quickly earn money within the session. So basically, it is an exercise to eliminate the uncertainty with regard to the market moves, because it is a man-made market. So in a man-made market, obviously some set of people, especially using the bank terminal, they try to manipulate the market, and in the process we should not be clueless. Instead, we should try to read the intentions of the players. So in any market wherein speculation is considered primarily, and also people are being triggered because of the greed, then you find cunning plays a vital role. So basically what happens, the players make a cunning move before that of their intentional move. So we will try to read their cunning move and then identify, okay, what they are trying to do in the market. And accordingly, we will also trade along with that of the players. So the cunning move will be always a fast move when compared to that of the intentional move. So this is the basic concept with which we will track the market and use the live market code page and find out what the players intend to do and then take the positions accordingly. So my trading system, or we follow three important components, namely the derived forecast. So the derived forecast is nothing but a statistical algorithm. Statistical algorithm means statistically it is being calculated in a sequential fashion. So various components, parameters are being taken into consideration, and they are incorporated at the appropriate level in our calculation. As a result, we will be able to get the trend, what the players intend to do beforehand. Then it becomes a forecast. So there is no point in giving the forecast as an ambiguous statement. That is, if FOMC is going to be like this, euro can come down, or if FOMC is of the other nature, then euro can go up. So if we give either way possibilities, then obviously we cannot call it as a forecast. We can only see the market possibilities. So when we talk about the market possibilities, either way it can go up or come down, then we have to wait for the data release to happen and see what happens to the other market. Sometimes it might move in line with the expectations. Certain other times you might come across, it might go against the expectations of the traders. So in the process, what happens, then the conventional forecast analyst, they say, okay, market has now followed the technicals. In the event if the fundamental failed, then they say market has followed the technical. That is why against the expectations of the fundamental, the market has moved. So when we come across still either way possibilities, even though we use the conventional statistical analysis and the fundamental analysis, we come across the possibility of the market moving exactly opposite to that of the expectations. Then what is the fate of any trader? Any trader has to go in for finally a gut feel. So he has to quickly enter into the market. In the process, what happens, then after the rise, he enters into the market at a higher level, thinking that he can do some breakout trade. And later on, he finds that he is being stopped out. So you come across many of the traders really get confused what to follow and what not to follow and where exactly they are being misguided, because they follow one system and try to enter into the market. Probably the time of entry might be a wrong decision. Then as a result you find that system does not work for him. Then he looks for some other alternative system. So they are going for the endless alternative system to find out what could be the possible moves in the market. So when you go in for the guesswork, then you find the market uncertainty continue to rise. When the market uncertainty continue to rise, and if the market moves against the expectations, then you find the trader develops the market fear. So to reduce the market fear, we need the derived forecast, which is time tested, which does not go wrong, and that is very vital for a trader to cling on to a forecast. So this derived forecast is based on various parameters which are influencing the market moves and also the decision making of the players. So based on that, these forecasts are given in the form of session-wise forecast. So on Mondays, I give this session-wise forecast. This is the slide showing what I displayed it on Monday, 19th of September. What are the possible moves in the market till Friday? Today we are on Wednesday, 21st of September. The market is expected to make a swing and form up, then swing and rise during the European session, and then swing and slide during the US session. So if you watch carefully in the market, during the early part of the session, they have made the downward move and slowly gaining the levels, making the downward move and slowly gaining the level in the case of Euro, GBP and Australian dollar. So the session-wise forecast explain to you what could be the possible move. So when they make a swing and form up, for example, then what you can do is when they make a dip during the early part of the session, we can try to buy and book profit during the later part of the session when they gain the level. So a buy and sell trade can be planned. So this is the way the forecast reduces the uncertainty. Instead of just guessing whether I can do a buy and sell trade or a sell and buy trade, the forecast reduces the uncertainty and to give the guidance that you can do buy and sell trade. So normally any person who knows the logistics will say that buy when it is cheap and book profit when it becomes expensive. So same you can follow during the early session when they are just making the swings near that of the low. You try to take a buy position and book profit when they form up towards close of the session. So I will show you the next slide explaining the session timings. So based on the timings, so Japanese session starts by 0030 to 7 GMT. 7:30 to 13 GMT is the European session, and 13:30 to 20:30 is the US session. The further splitting of the session timings, I'll show it with the help of the next slide. So here you find that when the early part of the session, 1.5 hours from the start of the session, we try to take a buy position when they are closer to the low during the early part of the European session, because the European session starts by 7:30 GMT. We are around 8:13 GMT now, and if you follow the GMT time, any part of the world, the GMT time will be the same. So when I say that it is 1813 GMT, whether I'm in India or in US or in Europe, everywhere the GMT time will show it as 8:14. So that is the advantage, so that we need not talk in terms of our local times. Then the other person who is listening need not convert it into his local time. So instead, we follow the universal standard time, namely the Greenwich Meridian time. Then we try to follow the market with the help of the algorithm to reduce the uncertainty. Now, it is not sufficient if you simply take a decision that I can do the buy and sell trade. We also need to see where exactly I should buy, what level I should buy. And for that, we need to fine tune the forecast using the market reading. It is a 24 hours market. So obviously we have to track the market all the 24 hours at frequent intervals, so that we'll be in a position to understand what the players are trying to do it in the market. So we do the market reading. How? Because the players are setting the initial low and the high in all the currencies, the majors especially, and the majors and the commodity pairs, the initial low and the high around 3:30 GMT. They set the low by 2:30 and high by 3:30, or set the high by 2:30 and set the low by 3:30. So they take 1 hour to set the initial low and the high in 4 majors and 2 commodity pairs, and use them as a reference level for the entire day till 24 GMT. So why they are setting the initial lows and the highs? So obviously the players need to communicate with their counterparts with specific language, and for which they are using the initial lows and the highs, and the counterparts will be able to, without talking over the phone or without communicating through email or any other means, they will be able to understand what the main players intend to do it. As a result, what happens, you come across the market moves in a specific direction. So when they just breach the high and stay above and continue to rise, their counterparts know very well, okay, the main players wanted to rise hero. So what they will do is, they will place the higher level sells in the market. Only when higher level sells are there, the main players can buy those things and the market can move up. If there is no sell order at the higher level, and if simply the players place a higher level sell, a higher level buy order to trigger the market to go up, no transaction will happen, because the counter trade is also necessary. Somebody should have placed a higher level sell order. That normal traders normally keep some sell orders sporadically at a higher level, but not at regular intervals, or not at further higher levels like 100 pips, 200 pips. When the market is, say, for example, GBP is around 1.2973, nobody will keep 1.3300 a sell order, because they know very well it is quite far off, it may not be reached, unless and otherwise they are going for a position trade. So invariably what you come across is that traders try to buy it at the market or sell it at the market, depending upon the market moves. So in such a scenario, When higher level sell orders are not available, then their counterparts will place them. That will facilitate the main players to buy. That is how the market moves up. So for that, we need to do the market reading, find out what the intention of the player from time to time. Say, for example, the forecast says that there is a swing and form of move during Japanese session. But when all the traders are holding a buy position in the market, or the traders are not at all taking the position because there's going to be a FOMC announcement, so let us enter into the market after the announcement. If they were taken a decision of that nature, then obviously the players cannot make any move, even though the forecast says that they will firm up. The players cannot make any move, and they may simply make 1 pip higher, 1 pip lower. That sort of swings, they will just do it in order to give the impression to the traders. Market is waiting for FOMC, but still it is alive. It is not closed. Market is alive and waiting for the FOMC outcome. So that sort of information is being passed on with the help of the live market code page by making a small form of or a small dip and things like that. So you need to read the intentions of the players. Why we need to read the intentions? The players are making very subdued moves, not even making 1 pip, 2 pip higher or lower. That indicates that the volume is not coming from that of the traders. In the absence of volume coming from that of the traders, the players have got no charm of making a rise or a drop, because they make the rise of the drop by circular trade. With that, they don't make any money. They sell from one terminal and buy from another terminal. Thereby, you find that suddenly the market push up by 1 pip, and later on it comes down by another pip when everybody is waiting for a FOMC outcome. So in such a situation, they do the circular trades without losing or gaining, and just to keep the market floating, give that impression to the other traders it is active or market is live. Then in such a situation, if you take a buy position and if you simply wait, then you will be waiting, because the players, when they don't find adequate volume to make any push on the upside or the downside, then they will be simply holding the market. And if we enter into the market, we will be holding the position. How do we identify that? Whether we can enter into the market or not? We can do it with the help of the market reading. Then, final thing, namely the trading strategy. Whatever be the type of forecast or the market reading, in whatever way we try to reduce the uncertainty with regard to the market, because with the help of the conventional analysis, we have nearly about 70 to 80% of uncertainty. That is, most likely the market might go up, but it can also come down. That sort of uncertainty is being lingering in the mind. So we hesitate taking the position. So we reduce the uncertainty with the help of the derived forecast. Say, uncertainty is reduced to 30%. And with the help of the market reading, we reduce the uncertainty even to 90-95%. So we have only 5% of uncertainty, and 90 to 95% we have the certainty. Still, the 5% uncertainty remains with us. So that can trigger the fear. And especially when you go in for a big volume trade, the fear will be enhanced, even when there is a move for about 25 pips or 50 pips, because that 50 pips move will take away enormous equity from us in the trading platform if you go in for a bigger volume trade. If you take only a nominal volume trade, probably the drawdown will be less and we may not develop the market fear, and we will try to handle it. So obviously, the quantum of trade we take is responsible for the quantum of fear we get from that of the market surprises. So first of all, we have to reduce the surprises. And even if we try to reduce the surprises to 1%, still, if our trade falls in that particular 1%, it can go wrong. And can we afford to take that risk? Why to take the risk when there is a trading strategy available for us? How we can do it? So even that 1% risk is being limited with the help of a trading strategy. Namely, we use the hedge order instead of a stop. Suppose the market euro is around 1.1155 and we feel okay, it is better to buy and market might go up. Then we can keep about 30-40 pips away a stop. If we keep the stop further quite wide, say when you take a buy 1.1155 and keep the stop at 1.1100, fine, this stop is wider. And we can say simply the risk reward ratio is, the risk is 50 pips, the reward is 150 pips. So 1:3 ratio. So we can keep that stop at 1.1100 and we can take profit around 1.1250. We can keep the stop below that of the resistance, below that of the support, and we can keep the exit order near that of the resistance. Fine. But suddenly, if the players make one big volatile move on the downside, hit the stops and gain, would have incurred 50 pips loss. Leave alone the profit aim of 150 pips. But can we afford to withstand 50 pips loss when our equity is about 3,000, 5,000, 10,000, etc., especially for the small traders? Can we afford to absorb 50 pips loss? Instead, can't we use the hedge order to limit the risk? If the position is hedged, it is similar to that of the stop is being filled. Fine. Wherever we want to keep the stop, we can keep the hedge order. The advantage is, if we keep the stop, if the stop is hit, our original buy position is closed. The stop closes the original buy position. So we don't have any position afterwards. Even if the market moves up afterwards, we don't have a position to put profit. Even though it gains about 150 pips, fine. In the risk reward ratio, we have encountered the risk first, then later on the reward, which we are not able to materialize because we don't have a position to materialize the reward. So we can theoretically talk risk reward, etc. But practically, if the risk engulfs our equity, then we will not have adequate courage to re-enter into the market and try to capture the reward. So human mind is such that once you become upset, then it takes some time for you to reconcile. So quickly we will not be able to take a mechanical position. So in such a situation, what the people have done is, they said that you can go in for robotic trading, so which does not have any sentimental influence. So automatically the robots will try to trade on your behalf. But you know, a machine cannot substitute the human brain. Even though it is invented by the human or human brain, but the machine cannot substitute the human brain, because the human brain uses innumerable logistics. But whatever be the program, we will have only a limited possibilities given to the auto trading system. That is why you come across so many people come out with the auto trading system, robotic trading, etc. But They are not able to withstand the test of time. And they come out with so many projections, so many ideas, and so many ad explaining some features, giving some big figures, and trigger the emotions of the traders to buy that product. But later on, when the traders test them and find that the success rate is very, very low, then automatically you know what is going to be the best marketing tool for any product for that matter will be the word of mouth. So suppose I experienced a good feel about a trading system, then automatically I pass on to 5 people that I am using this particular system which is really working well. And the word of mouth with their co-traders alone can sustain and alone can really give the real boost to whatever be the marketing strategy that people use it in the market. Ultimately, the word of mouth matters much. So you come across there are so many promotions happening, and also people are looking into the reviews in such products or services. They look into the reviews. Why? Because they wanted to find out how other people feel about that particular product, especially those who have used it. Why are they going for such reviews? Because in order to reduce the uncertainty, in order to avoid getting cheated, they wanted to have such reviews. And many of the people, what they do is they prepare the reviews of their own and say that it is very positive. So you do come across when the people have got the intention of cheating, they will try to enter at every level and try to cheat the people who are weak-minded. And so that the people will learn out of costly experience after losing money. So ultimately, the simplest method of protecting your equity can be the hedging order. So you come across the European and Australian trading platforms. The hedging facility is available in the same currency pair. So suppose you've got a buy position in euro, and you can keep, instead of a stop, that is, stop is nothing but a sell order at a lower level. Instead, you can keep the hedge order in the same currency pair, 30 or 40 pips below the market. If the market goes there, that order will be filled so that you will have a high level buy, lower level sell. Still, both the positions will be there with you. But if you use the stop, if the market goes down and fill your stop, your buy position is closed. That is the difference between using a stop and using a hedge order. Many people say that if you use the hedging, that means you do not know how to trade. But any product for that matter, or any service for that matter, you do come across there is a risk limiting factor associated. Okay, you have got a vehicle to drive, and anybody drives the car only after learning how to drive the car, after getting the license from the government. They drive the car in a public place. But in the car, you do have the brake. Nobody sells the car just because you know how to drive the car. Brake is not needed. Brake is needed in the event if there is a sudden reaction happens in the roadside and somebody crosses suddenly, unexpectedly, then you need to apply the brake. So you do come across such knee-jerk reactions are bound to happen, however experienced you are. In such a situation, if you have a brake instead of a stop, a hedge order, and that will apply the brake and give you a comfort zone, then from that of the emotion you will come out and realize what happened to that of the hedge order. Okay, my hedge order is filled, but still I have a buy position as well as a lower level sell position. What do I do with such positions? You will be able to relate it to that of the market. Okay, the market is below that of the hedge level. oh, that means thank God that I got it hedged and market has come down drastically. So you're able to immediately find a break is applied, but still nothing happened to your position. And later on, the market has come down. The simplest way of trading is, okay, accept the loss and close the buy position with the hedge position. If you would have used the stop, you would have filled the stop immediately and instantaneously your buy position would have been closed. Instead, if you use the hedge order, then it gives the impression to you later on the hedging is continuously making profit. So market has come down. Then you understand that thank God I got it hedged and I kept the hedge order 30 pips below that of the buy position. So I will accept the loss of 30 pips, similar to that of using a stop. Then close the original buy position with a stop, with a hedge order, similar to that of accepting a loss, which happens when you use a stop limit order. Now, if you are slightly smarter, then you can visualize it. Okay, I got a buy position as well as a sell position. In the market, you do come across some people holding the buy position, certain other people holding the sell positions. Some have got the buy and sell idea, certain other people have got the sell and buy idea. Why not I think in both the possibilities? Why not I think that why not I take the buy position separately and view it separately, how I can make profit, and sell position separately and view how exactly I can make profit. Then you are slightly smarter. Rather than just telling that my position got filled, my hedge is filled, so I got struck. If you simply say, that means you are not able to proactively take it further. Instead, you become pessimistic, you become subjective, and you become upset. Then once you become upset under the influence of the sad condition, then you are not able to think how exactly you can come out of the position with a profit. But in the market, only if we take position we can make profit. Without taking position, simply say for 1 hour euro is going to rise or euro is going to drop. When I continue to shout, I don't make any money. Only if I take position in the market with my equity, I'll be able to earn money from that other market. So there is no point in commenting about the market. Instead, we have to learn the art of trading. So we fine-tune the risk by using the market trading technique and use the hedge order to limit the risk by in the basic trading strategy. Then what happens? We need to take a decision how exactly we have to exit out of the position with profit. There comes our smartness. But you know that when you watch the market for several days, euro swings at a higher level and later on drop, then swings at a lower level and later on rise. So we always end up in repenting. Oh, I could have kept the higher level buy and I would have waited for 2 days, I would have earned money. And I would have been in the money. But suppose you take a lower level buy and the market goes up, you are in the money, you become greedy. You simply watch and say that, okay, euro could go to 1.20, I'll book about 700, 800 pips profit. So you are under the grip of greed and watch, suddenly euro comes to 1.10. Then you say, oh, I could have just realized the profit and failed it because of that euro has come down again. Now the position is making loss. So you find that people lose money out of greed as well as out of panic conditions. So both the emotional conditions are detrimental for trading. So how exactly we have to trade? So my system suggests that use the live market quote page as a simple tool to enter and exit out of the market. What you do is we note down the initial lows and the highs around 3:30 GMT and identify the net change in the live market code page, and also find the difference between the high and the low. How many pips are there between high and low? Now in the case of euro, high is 1.1159 and the low is 1.1123, and the difference is hardly about 26 pips or around 30 pips. And in the case of yen, the difference is about 178 pips. So 170 pips. So in the case of GBP, the difference is about 50 pips or 55 pips. So you find some are showing lesser pip variation. Certain other pairs are showing more pip variation. What do you understand out of that? The players have got a system because they also need to make the payment of the margin similar to that of our equity. They also need to give the margin for their positions. They cannot just like that take any number of positions in the bank because banks are being monitored. So obviously, like any other trader, they need to give the margin. So whatever be the billions of dollars margin they are given in the private banking arm, still they handle only two pairs at a given time. They continue to do the circular trade and gain the level or drop the level. And thereby they do it in two pairs at a given time. And those pairs make initially more than 40 pips spread between the high and the low. In such a situation, if you bet in those currencies, you'll be able to make quick profit. Instead, you do enormous analysis in the other currency, for example, euro. You just apply various types of statistical analysis and try to calculate how exactly euro is expected to make the move and take the position. But hardly it has moved about 25 pips. Where exactly you can take the position, where exactly you can make profit. So you need to identify that is possible only with the help of the live market code page, because here you come across the comparative outlook of all the majors. In the individual charts, you don't. You only focus on one particular currency. So obviously you get moved with regard to the moves of that particular currency. Say for example, you have done a study with regard to GBP, which is showing a big downward move. Immediately you become bearish. Then with the same viewpoint, you look into that of euro and expecting euro to come down, and you take a sell position, and later on euro is not coming down. Suppose when you look into GBP, which is making sideways move and trying to take a sell position thinking that it will come down, or you just assume, okay, euro GBP has already come down, euro has already come down, only Australian dollar is at the higher level. So if you take sell position in Australian dollar, it will also come down following euro and GBP, and you can book profit. If you make a relative study, you might come across Australian dollar continue to gain the levels, and that may lead euro and GBP to gain later on. You get vulnerably trapped. So when you go in for such a relative study, the coincidences you assume as the probabilities, and later on you find that they are nothing but the coincidences. And your understanding of the market becomes wrong. When you understand your understanding is wrong, when you take a decision and take the position, and the position start making laws, then you understand your study is wrong. Then later on you think of alternative study, thereby you will be able to understand a better way of taking position in the market. But whatever be the type of understanding or the forecast you use, you still find the uncertainty ringing in the mind because you don't have a specific system in hand. If we have a specific system, like in an automobile driving, so when you're driving a car, you have got a specific system, the steering to control and make the moves of the car, studying the road signs or following the road signs. Then you've got a brake to stop the car at any given the time frame or the level. Then you have got accelerator to make the car to move, and you are able to judge, okay, this much of press will go about 50 kilometer speed or mile speed, or if I press little more, then it goes higher. Then you have the gear system to accelerate the speed. So we have everything which is all well informed. So when you are well informed, okay, if you want to accelerate and go, then increase the gears, then increase the acceleration, then you go in at a higher speed. So we have a defined system. Whereas in trading, unfortunately, you do not come across the defined system. In our conventional statistical and fundamental studies, because it is 24 hours market, even though it is of a shorter duration, even the stock market, you find that the traders do all the studies and finally they go in for the gut feel whether I have to enter into this particular level or wait for the further time. So you need to find a defined system. Then you find our entry and exit will become more appropriate. So please reflect on these information, what I am trying to give it, so that you'll be able to really develop a system of your own. Not necessarily you need to follow my system. You can develop your own system and still become a successful trader. But my humble request is, whatever be the type of study you do, still you develop the habit of watching the live market page. For the past 19 years, I've been, or more than that, I've been watching the live market page, nothing more than that. And I stopped using all the statistical analysis, even though I was a statistic professor when I entered into the market. And later on, I found that the players are making the market to pretend as if it is following technicals and suddenly reverse the market to trap the traders and say it is because of fundamentals. So you find, okay, the fundamental is going to drive the market. You follow the fundamentals and take the position, and suddenly they say that it is because of technical, the market is simply reversed. So you find every time that statistical or the fundamental analysis is not in a position to explain when the time, when the trend reversal is going to happen in the market, when the intraday trend reversal is going to happen in the market, when the session-wise trend reversal is going to happen in the market, when the weekly trend reversal is going to happen in the market, when the monthly trend reversal is going to happen in the market. As long as your system does not address when the trend reversal is going to happen, the uncertainty will continue to remain in the mind of the traders, however expert he might be. So if you want to get rid of that uncertainty, you have to incorporate the time frame into your analysis. And if you incorporate the time frame into your analysis, then you end up in identifying the time frame of the market. Every market has got a time frame. Stock market, for example, it has got a start time, end time. Then you come across the early part of the session and the late part of the session. So you come across these time frames are fixed. So you find the market is very active during start of the session. As soon as New York Stock Exchange opens, immediately you find very volatile move. Afterwards, it becomes subdued. And later on, towards close, you find very big activity. Why? Because whatever the position you take in the market, you need to close such positions. Why? What is the necessity? Why we should close it? Because we take the positions in any instruments in a leveraged condition. Suppose you buy $1,000 in the market. Suppose you withdraw from your bank $1,000 and hold it when dollar is very, very weak. You buy it, and later on you convert it into euro when euro becomes very strong, or when euro becomes very weak. You are able to take a delivery of the currency and you are able to convert it into euro. So when a currency is very weak, you try to buy. When that particular currency becomes very strong, you exit, you make money out of that. But in the market, you are not permitted to do that. Instead, you are expected to take positions. So in the currency market, you find that you have to take the leveraged position. 1:30 or 1:50 or 1:100. There are platforms offering 1:500. That means you pay only one part and take 500 parts, the position. Or you pay one part and take 30 times that particular part, the position. So that is what the ratio of leverage is. In such a situation, what happens? When you have taken the leverage position, there is no actual currency buying. You only take a position, and that position you have to close it in the same market. You can't buy it from New York market and sell it in some other market, FTSE market. Because currency, if you buy it in one trading platform and sell in another trading platform, you don't close the position. You have only taken the opposite positions in two different platforms. So wherever you take the position, you have to close it in the same platform or same bank. Only then you find the trade is concluded. So they offer it in such a way, they structure the product in such a way so that you are forced to speculate and you are being put under a lot of constraints and restrictions. So that is a basic idea of structuring a product. So all the banks, they use all of their intelligence and try to structure the markets of that nature and give all the leverages to the traders so that they can take the position out of speculation and later on, or any scientific study, and later on they have to close the position with the same platform, same broker. So this is what happens in the market. So in such a situation, we need to find when exactly the traders will be squeezed to close, open or close the position. Early sessions you will come across when there is a quick move, the traders will participate in the market, enter into the positions. And later on they might wait, but when it becomes late for them, then automatically they try to wind up the positions. This is what happens during the early and the late sessions. So early session, they participate in the market. Late sessions, they wind up the positions. So here you find it is a 24 hours market. It is next to impossible for any human being to keep awake all the 24 hours of all the 5 days in a week and try to trade. He has to take rest because our human body is controlled by the biological rhythms. So we cannot keep awake all the 24 hours of all 5 days. So in such a situation, we can only trade in 2 sessions maximum. And we can monitor the 3rd session to a certain extent. So depending upon our global positioning, suppose I am in Asia, I'll be able to watch the Japanese and the European session, a predominant of the US session, and later on I have to go to rest. Suppose somebody is in Europe, we'll be able to watch the early part of the, I mean, you'll be able to watch the late part of the Japanese session, the European session, and to a certain extent the US session. Suppose somebody is in US, will be able to watch late part of the European session, and you'll be able to watch the early part of the US Japanese session. So that will be the restrictions you come across for every trader. And there is no point in keeping awake, burning the candle all 24 hours and watching the market. And by that, you lose your stamina, you strain your body, and you become sick. And whatever you intend to earn from that market might be used for your medical expenses. So there is no point in making a stressful trading. Instead, you should be able to make it the trade at ease condition. So only when you trade at ease condition, the emotion does not take the control over that of your trading. So once there is no emotional grip, you find invariably you are able to take sensible trades and earn money from that other market. Don't make any time the trading a stressful exercise. Any decision we take under the stress will end up wrongly. Under emotion, if we take any decision, it will end up wrongly. It will complicate the issue. So if you want to take an appropriate decision, it should be a fearless condition during which we should be able to take appropriate decision. How to get rid of the market fear in order to trade fearlessly? So you have to get rid of the uncertainty. Once you get rid of the market uncertainty, automatically the fear is not there for you to influence you to do the wrong trade. For that, we need to have a system of information about the market which is not being informed anywhere in the world. All the information you come across in the world are just to give the misguidance to the traders. That is the way it has been structured. Only then the traders will follow that and get cheated, so that they will be able to lose the money and the big players are able to earn such money. So as long as there is a money power with regard to the players, so they will continue to manipulate the market in such a way. But in such a condition, you need to earn. Probably you need to earn to improve your lifestyle, or you need to earn as a full-time job, or you need to earn in order to clear off certain debts. So you might be having so many other stressful conditions to enter into the market. But in the process, you should not become addicted to trading. So what is most important thing is you are entering into the market to make money, and keep the objective very clearly and stick on to that objective. If you are not able to earn and if you are losing money, don't continue to try that. That means you have not understood the market properly. If you have not understood the market properly, it is something like you wanted to enter into the car and reach the destination while learning how to drive the car. Will you be able to reach the destination? Probably you may have to reach heaven straight away by meeting some accident. So you cannot enter into the car and learn the driving when you have an urgency to reach the destination. So if you want to learn driving, you have to go in for a class, or you have to do it calmly and not in a live condition, but in a demo condition. So you have to invariably take it in a separate track and learn how you have to develop the road sense, how you have to apply brake, how you have to accelerate, how you have to turn the steering and find how much that wheel is turning on the right or the left. These things are to be calibrated mentally, and then you can develop the road sense and start driving the car. But 90% of the traders, they don't learn the art of trading, but they enter into the market and then assume that they know everything because they have read everything theoretically, and they wanted to try that. And once they try to earn some money, then they develop the overconfidence or lose more money. They don't develop this system. When they decide that condition, when they lose substantial money, then they think that, okay, there is no point in trading or continuing the trading in the market until otherwise I develop a system and trade. But unfortunately, what happens when he goes to various classes to learn the trading, he is not having adequate equity to trade and earn money following that particular system. So he does not disclose how much of equity he has got, but he wants to talk to people as if he is a big trader, because this is the normal tendency of a trader, not to talk about the failures, talk about the success all the time. I had done one trade, I made about $3,000 in single shot. You will say, but you would have lost $5,000 in previous trade, but that he will not talk about. So this is a normal tendency. Nobody just elaborate the failure. We only talk about the success because of our egoistic condition. So in the process, what happens? We fail to accept our mistakes. When you fail to accept our mistake, and when such mistakes happen in trading after learning from somebody, we point the finger towards that particular person and say that, oh, he has misguided me. I thought that he will be able to give a good system, but unfortunately I followed it and it becomes a failure. Because you develop this sense to point out the fingers against others without understanding the mistake lies in you. So any analyst, if you follow the complete system, what they are giving it, you should be able to earn to a certain extent. Suppose somebody is following technicals and fundamentals and continuously giving the trade call with the stops. If you strictly follow with the stops and trade, you will be in a position to earn at least a nominal profit at the end of the day. But you modify it. You try to take the position and don't keep the stop. And if the market goes against, you ask the fellow, then I take an as per your recommendation a buy position. The market has gone down drastically. What do I do? It is making about 200 pips loss now. But what the analyst can do, he is not responsible for you to make 200 pips loss because you failed to keep the stop. So it is a package. So anybody who gives the trading system, it is a package. You have to follow the complete package or just to discard and develop your own package. You try to take that package and use only 50%. And that 50% you don't follow and put the blame on him. That means you fail to realize your own mistakes. So if you take such systems from n number of people, you will not be able to earn money. It is simple. As long as you don't realize where exactly you are going wrong, where exactly you are committing mistake, and if you are not in a position to do a self-reflection and self-analysis, then invariably you find that you try to point the fingers on others, but nobody will be able to help you other than yourself in this world. So you can point out the fingers to any analyst or any coach or anybody for that matter and say that because of him I lost the money. But you can only blame him. But you are the one to lose the money, not the other person. So if you are really caring for your money, then what you have to do is you have to focus on your money and see that you have to be conservative. How exactly I can just make that money to grow? So what you will do, you will try to do the mock trading. Try to do a trading in a demo trading platform and develop a system which is foolproof. Then you apply that in a real trading account. You find you are able to really make good profit and fine tune the trading depending upon the changing environmental condition. then you become a successful trader. But invariably what happens, such time frame is not available for traders. And somebody has suddenly found some debt happens in the family. He has to necessarily generate 20,000 or $30,000 suddenly and meet out the expenses. He has got no other system than to enter into the market where he can make about investment of 5,000, thinking that he can earn 20,000 out of that and clear the debts. So out of emergency, out of necessity, people enter into the market. And when the stress is hanging on and you say the deadline is coming closer, then you become emotional and you go in for a distress trade. In that process, you lose your 5,000 also. So trading is an art. You learn it first of all. And once you become a perfect trader, then enter into the market. Then you will be able to really understand. You can consistently make money from that other market. It is possible. There are innumerable people, they are consistently making money from the market and they learn the art of trading. So you have to understand the time frame associated with the market. And any market for that matter, the time frame is vital. And you find the momentum in the market varies depending upon the time frame, time slot wherein you take the position. So in such a situation, what you have to do is read the intentions of the players. Read the intentions of the players and understand what they are trying to do it in the market. They do it purposely. And just from the morning, from that of the Japanese session, you would have noticed that there's going to be news from that of BOJ. So Bank of Japan was expected to announce certain parameters. So in such a situation, what happened? The players made wild either way moves in Japanese yen, USD yen. What they did, they made a quick dip before that of the announcement. Then after the announcement, they quickly raised it to 102.78. Then everybody thought that, okay, fundamental is driving, and because of that, Japanese yen has become weaker, USD yen has become stronger, or denominator yen has become weak, thereby the level is going up. Then if they think that, okay, it is going to continue to rise and take the buy position, what happens? They started making the slide. This is what they do is, they create the market sentiment and act against that of the trader's pending position. So the sentiments are created by using the data. So from time to time in a week, you come across various types of data being released. And before the data, they will simply give the story that everybody is waiting for FOMC to come out. Everybody is waiting for BOJ outcome. So they continue to create the stories of the nature so that they are able to sell their product. And in that process, what happens? After the BOJ, if somebody is thinking that he can take a trade, then it has gone either side. So what sort of trade I would have done in that process? When they make a dip, we assumed that they will make for the dip and waited carefully. And after the data release, it went up, thought that I can do a breakout trade and take a buy, it drops. Then the trader becomes fatigued. There's no point in waiting for the data release to happen. Instead, I should position myself beforehand. But beforehand, the talk in the market is so uncertain and everybody say that it is going to be other way. So you don't freely take a buy position when Japanese yen, USD yen was making a downward move, because the comments in the market were really discouraging you taking the position. So you find the uncertainty prevails in the mind from time to time in different forms. So every day you come across people talk about non-farm payroll, BOE, interest rate decision, the ECB interest rate decision or easing out and things like that, FOMC interest rate decision or as a statement, and you find every day during the European and US session or a Japanese session, there will be a data release and there will be uncertainty. Besides, you do come across suddenly the speaks by various finance ministers. And you know, when the finance ministers talk, immediately the players make the very big drop or the very big gain in the market. As if something miracle has happened in the world. So when BOE governor speaks, immediately they will drop. When Fed chairman speaks, immediately they gain the level. How it is possible? So if the market can go up and come down like that, these finance ministers can continue to talk alternatively. Thereby, the economic productivity will go up. The markets will boom like anything. There is no real productivity needed in the country. There is no GDP growth needed in the country. And so they just create the hype out of such stocks. They say that, okay, when they are having such mindset, and automatically they will be doing good for the market. That is how people assume. And the players are so clever, and during such talks that simply say that so and so is dovish, so and so is hawkish. And you know that the hawkish and the dovish are the normal behavioral strategies. And they use such terminologies in Forex market and also other markets and say that he is dovish because of that US dollar is weakened, or so and so is hawkish because of that US dollar is strengthened. So they simply give such attributes and make big moves on the upside or the downside. So when they make such moves, we need to identify whether it is a true move or a false move. As I told you, when they gained quickly the levels in the case of USDM, is it going to be a true move on the upside or they are going to reverse that? We need to identify. For that, the types of moves they are doing it in the market are vital. So if you identify the type of moves, what they are doing it in the market correctly, then you will be able to take appropriate trading decisions. There won't be any uncertainty for you. What you do is, these are all the types of moves. I'll explain it now. There are certain moves that happens in less than 30 minutes during early and the late sessions or during gap time, what I explained it with the help of the time frame. A stop and is a move which happens for about 15 to 25 pips above that of the initial high or below that of the initial low in less than 30 minutes during the early or the late sessions. So times are all fixed. We need not expect during that mid session. A false move is the one which happens in less than 30 minutes and they come from that of the high up to that of the low without breaching the low, come up to that of the high quickly and rise above that of the high and go continuously upward. And that is a false move. So they had done it in the case of Japanese yen. They just made a false dip before that of the BOJ decision. And then subsequently they made upward move and stopped cutting the new high for 30 minutes and started making the slide. So every 30 minutes you find the direction of the trend changes. So if with the help of the 30 minutes chart, you will not be able to find out. Only by watching into that of the live market code page and related time frame in GMT, you will be able to understand that. So a false move is the one, they come from high to low, pretend as if they are going to drop it and suddenly go higher than that of the high and stay above there for 30 minutes and continue to rise. And that is a false dip before the rise. So this, they do it before that of the data release. And today you come across the FOMC announcement. And at that time, you will come across 18 GMT. They will make a false dip and then later on gain substantially with the help of an upward spike. That is what's going to happen in the market. I'll explain in detail during part 2 of the webinar. So you find such false move happen before that of the data release. Then you come across the other type of move, namely more than 30 minutes up to 2 hours. They make a drop and go below that of the initial low. Stay there for more than 30 minutes. That means they will stay there for up to 2 hours. But they don't breach the new low every 30 minutes. That is an extended move. And up to 2 hours, they hold it below that of the initial low and then start rising it and continue to gain slowly on the upside. So that is referred as an extended move. The extended move, they do it alternating with that of the intentional move. What is that intentional move? It is a move which happens for more than 2 sessions. Up to 2 sessions and the start of the 3rd session and reverse the market. The players don't do hat trick in the market. For more than 2 sessions, they don't make similar moves. More than 2 days, they don't make similar moves. More than 2 weeks, they don't make similar moves. So they always change it. Only then the traders can develop the uncertainty. They continue to make in a similar way. Japanese session slide and European session rise and the US session slide. Everybody will know, okay, European session rise, I'll take a sell, I'll book profit during the US session drop. They can plan it. So they want the traders to plan and go wrong. Only then they lose money, they become stressful, and they start doing distress trade. And the players are able to earn continuously from that of the market. So you need to understand that they make the intentional move, which is a slow move, which happens every 30 minutes. They breach the new high and go above. Every 30 minutes, breach the new high and go above. And that is intentional move. Extended move, they breach the initial high and go above. Stop cutting the new high for more than 30 minutes and hold for 2 hours near there and start reversing it. That is extended move. So what they do is they make a downward extended move for 2 hours, and then for 2 sessions they continue to gain the level. 3rd session, they quickly gain the level and reverse the market. This is what they do every day, every week, every month. We need to identify. So don't think that market is not manipulated. If you watch it following the time frame, you will be able to understand they alternate the extended move with the intentional move. And in between sessions, they make the early session the stop and the late session stop and during that of the gap time, they make the false move. And before that of the data release, they make the false move. And swing, they do it during the mid session. Without breaching the high or the low, they make small moves. Now they are doing the swings. They are making swings near that of the high or near that of the low or between the low and the high, just to keep the market floating. And in the market, carefully if you watch, you can find how slowly they are making the net change from negative to positive. I want you to watch the live market code page simply so that you will be able to understand that they are gaining the levels first in the case of Australian dollar, and later on they are gaining the levels in the case of euro. Now it has become unch from that of the previous day close. And in the case of GBP, it is still making about 9 pips negative net change. So all the numerators, slowly one by one, they are gaining the levels. What about the denominator? They just showed a big positive net change in the case of USDN. Now it is making only about 7 pips positive net change, which has made the slide. And they are likely to come down when euro and GBP go up further. So what the hype they created for BOJ will be simply discounted, and they will come below that of 101.50 and hold. This is what they do it. Then everybody forget about BOJ. They all talk about FOMC. So knowingly or unknowingly, the analyst also forget about what they said during that of the BOJ interest rate decision, and they talk about FOMC, forgetting what they have said earlier. Then in that process, what happens? The sufferers are those who had taken the position following that earlier talk and later on find that the market is going against the same analysts are talking differently now. So that is what the traders get confused. So the trading is different from that of market analysis. Trading, you need to identify who is trading against you and read their intentions with the help of the type of moves they are doing it in the market in order to trap the traders. So you avoid getting trapped is most vital. So when you study this, the type of moves they are doing it, you do come across one more move called as extended stop end, which happens during the monthly trend reversal time. What they do is they, from that of the high, they breach the low and drop for about 150 pips net change level and reverse the market within the session or the next session and go above that of the high and gain 150 pips. This happens during that of the data release, especially during the month end and the new month beginning time. They make such big 200, 300 pips move, and that is referred as the extended stop end or either way stop ends. So we need to identify those type of moves when they will be doing it. So on a daily basis, if you expect the extended stop end, then you will be continuously holding the market fear and you will not be able to enter into the market. So you need to identify the time frame. Nobody talks about the time frame. It's very pathetic situation. Actually, people should say that during the month end and the new month beginning, the players are trying to handle the derivative market, especially the futures and the options market, and also the exporters and the importers. They go in for the forward cover. In order to hit their stops, the players make big moves during that of either way moves during that of the month end and the new month beginning time. During such time, they will make either way stop ends, very volatile market. And during second, third week, and fourth week, they make only one-sided move. So if you understand that, then you will not envisage such big moves during that of the mid-month, and you will be able to trade easily. Near that of the low you can buy and book profit, near that of the high, and easily you can earn money. And you can do the position trade also during the mid-month, but not during the trend reversal time of month end and the new month beginning time. So they are all the higher time frame moves in the market. Now, before going to that of the trading strategy, I'll explain to you with the help of the initial lows and the highs, what they are set around 3:30 GMT today. In the case of Euro, they set initial low 1.1148 and the high 1.1157 by 3:30 GMT. What happened? They came down to 1.1123, reached the stops or hit all the stops and come above that of 1.1148 and went up. Now they are holding around 1.1148. It is an extended stop end for 2 hours and they are holding it. Hope you are able to understand. And they made the breaching of the high by 2 pips. 1159, they made the breaching of the high. 1157 was the initial high. They just hit the stops above for 2 pips, pretend as if they are going to rise, and then made the dip and breached below that of the initial low and formed the new low and stopped cutting the new low and still holding around that of the new low. Why they should hold it around 1147? Why not they hold it around 1150 or 1155? So these are all nothing but the transmission of information to their counterparts. So you need to understand that and follow that. So when you are talking in English, they are talking in some other sign language. So if you want to really be smart, you should learn their sign language. Then you will be able to really learn their intentions and trade accordingly. In the case of GBP, 1.2975 was the initial low. From there, they came down to 1.2946 and come up to that of 1.2978, above that of the initial low. And the high was 1.3005, which is not breached. So they came below for about 30 pips, hit the stops, and come above that of the initial low and staying above that of the initial low. If you think that GBP will come down again to 1.2946, it is very unlikely. Whereas Euro, they will try to make a dip around 2 hours and then start rising it so that the traders will get confused whether the market is bearish or bullish. But actually, the players are just holding above the initial low in GBP for more than 30 minutes, indicating that they wanted to gain from these levels. So once you understand this, okay, the next move is going to be intentional upward move, then you can take a buy. But still, you're not taking the buy at the lowest level. Normally, what the people say, you keep your stop below the resistance, below the support. Why are we going for it? You keep simply the 30 pips hedge order to limit the risk. In the event of the hedge is being filled, you watch whether the hedge is filled during stop end or during extended move or during intentional move. Then accordingly, you can handle the hedge. So if you know the type of moves, then you can handle the hedge easily. We do not know the type of moves. You do not know how to read the type of moves with the help of the live market code page. Then once a position becomes hedged, you think that you are struck. It is a question of only perception. Suppose there is a rope on the road in a dark condition. Then you assume that it might be a snake. It will appear like a snake for you. But actually, if you watch carefully and watch what it is, then you are able to recognize it's nothing but a rope. Then you get rid of the fear. So it is nothing but the market perception with which you develop the fear. So what you perceive, if it happens to be wrong, you develop the fear. So you normally think when you are interacting with a person that he is a honest person. So you can trust him. You can give him money so that he will be able to help you returning the money promptly. Or you are trying to identify a life partner and you find that person seems to be honest. Then you try to be associated with him. And later on you become disappointed when he is not able to honor his own words. If a person is not able to honor his own words, but he expects others to honor his words. Normally, when he has taken the money from you, he will say, tomorrow I'll give back the money. You respect the word. And the next day comes. Then he says that kindly wait for another 24 hours. Then you lose trusting his word. Because he is not trusting his word, then automatically he cannot expect others to trust the word. But a dishonest person, he will not trust his own words, but he will expect others to trust his own words. This is what happens in the world. So similarly, you find in such a situation happens in any transaction. Then you find the disappointment comes in. So once the disappointment comes in, then you become distressed. You act emotionally. That is why you come across in such a condition, you close your position and later on you see the market is moving in your favor. Then next time what you decide is, okay, I should not act emotionally. I'll calmly wait, but the loss continue to mount. When the market goes against you, you are not able to identify the type of moves. And later on, you become distressed and close the position, and then later on see that the market goes up. So in such a situation, 2 or 3 occasions you pump in the money and see that you are able to earn back. But later on, finally, when you pump in more money, the drawdown becomes bigger in the absence of stop. Then you find that account is blown out. That is why many people say in the market that I have blown 3, 4 accounts before learning the art of trading. That is a costly way of learning. So what you do is, everybody can undergo the same experience and learn. Suppose somebody says that you touch the fire, it will hurt your finger. Then you learn from other man, okay, I should not touch the fire. If you touch the live wire, electric wire, it will give the shock. Okay, I don't want to touch the wire because I learned it from others, so I am not harmed myself. Whereas if somebody says that, no, I wanted to really experiment myself so that I learn it in a hard way. Then later on, you touch the fire, and the finger is burnt, and he gives the treatment for the finger for 10 to 15 days and become all right. And again touches another wire, live wire, and it gives the shock and it paralyzes the finger. And later on, it takes about a month to recover from that injury. So in such a situation, he learns it in a hard way. His objective is to learn, but in that he is learning all unwanted experiences. So the purpose of education is learn from other experiences. So that is why you come across, you go to the college or you go to the school and learn. They are all nothing but others' experiences, which we call it as science. So others' experience, you learn it without undergoing the stress of identifying such concepts, so that you are able to progress further. In the process, you find there are certain concepts which have undergone modifications. You learn that modifications also. That is how we go in for a higher studies. So you find that invariably the players make similar moves in the market, and you need to identify what they are doing it. So as I told you, in the case of GBP, they are unlikely to drop below 1.2975. We'll watch and see. Now in the case of yen, which is an interesting pair, there 101.50 was the initial low. It came down to 101.08 during a downward extended stop and then subsequently it went up. 101.80 was the initial high, and they went up almost 100 pips above that, 102.78, and come down. Now holding around 101.72 below that of the initial high. So it was an extended stop and on the higher side for the reaction of BOJ. And now they wanted to make the slant and go up to that of the new low. That's what they intend to do. You can watch after that of the FIMC. They'll come back to 101. So if you read their intentions, you will never fail in market. Similarly, in the case of USD CHF, 97.86 was the low they set, and 97.97 was the high. They breached the low nominally by about 10 pips to 97.65, and again gone up to 97, above 97.97, went up to 98.14, and come below that of 97 and holding around 97.73, below that of the initial low. So which is showing negative net change. And initially they just came down from that of the low, went up, then again come down, and they are holding below that of the initial low. So they made an upward stop and then come down, and they are expected to go down. Why they are going down? See, in the case of euro, you find negative net change. In the case of CHF, you come across negative net change, USD CHF. So they are handling euro CHF on the downside. If you look into that of the pair, you'll be able to understand euro CHF. They are making it downward move. So this is how they make the moves during the mid session in the crosses. So they intend to make either way stop ends, wide range swings in the case of USD USD CAD 1.3176 was the initial move and came down to 1.3155 and went above that of 1.3198 and found 1.3205 during stop and come down to 1.3163 below that of the initial low. What they intend to do? They just went up and made an upward stop and come down. As I told you, a false move or a stop and come down and staying below that of the initial low for more than 30 minutes to continue to slide afterwards. USD CAD, they are expected to make a continuous slide for 2 sessions. Then in the case of Australian dollar, 75.45 was the initial low. They just came down to 75.35 and come above, and 75.60 was the initial high. They went up and formed 75.95 as the new high. They are holding around 75.90, holding above that of the initial high for more than 2 hours. So they are likely to gain the levels slowly before and after FOMC. I need not wait for FOMC to come. I can straight away understand with the help of the move they have done it. Why they make such moves? They create all uncertainties. And on Monday, they just made the gains in the case of Euro and GBP as if they are going to gain continuously. Then Tuesday, they started making the slide and created the fear FOMC is going to be very strong. And as a result, you will come across Euro and GBP will come down drastically. And also given that impression that the sleeping giant USD is going to rule the world. So that is how they created the feel. And now after the FOMC, you find already people started talking that it is going to be dovish. Our statement is going to be dovish. There is unlikely to change the interest rate. And when they talk like that, then automatically you find that people get confused because they have been talking that US dollar is going to be the king. And later on, they are all talking against that. Then they will say that is how the market is. We cannot have any a permanent condition in the market. It will be dovish and bearish and dovish and hawkish alternatively. That is how they will say. And finally, you come across that the players intend to gain the levels in the market. So now we understood with the help of the initial lows and the highs what they intend to do it. Now what we do. So we enter during the early part of the market. That is when market European session starts around 7:30 GMT. Before 8 GMT, near that of the low, we try to take a buy because the focus says that they will gain the levels. And later on, we try to wait for the market to go up and keep the hedge order to limit the risk and keep stop at entry and remove the hedge order once the positions start making profit. And then subsequently keep the exit order 45 pips or 75 pips away from the other market and use the 25 pips trailing stop if the positions start making profit and maximize the profit. That way, by moving away, they take profit order as well as the trailing stop. That is the simple trading strategy. In the event if the position is hedged, what we do is we use the hedge as a separate trade and see whether the hedging is making profit or loss. The hedging is not making profit for 30 minutes. That means they filled it during stop and downward stop and the hedging got filled and they wanted to gain the level. So you close the hedging with 2-3 pips loss or we stop at entry. Keep another hedge order 20-30 pips below and let them gain the levels and trail the hedge order upward until you are able to keep stop at entry in the buy position. So that way you can continue to handle the hedge. So if the position is hedged, you should not think that you are struck. It gives you an opportunity. It gives you a relaxing time to think what is happening in the market. Realize what is happening in the market. And that you will be able to get only if you look into that of the live market quote page. hedge. After hitting the low, after hitting your hedge, the market hardly has gone by 1 pip. Afterwards, it has not breached the new low for more than 30 minutes. So they are unlikely to drop and they are expected to gain the level. You will be able to judge with the help of the live market quote page and close the hedge order, keep another hedge order in the event if it is filled, and wait for the market to go up and trail the hedge order upward until you are able to keep stop at entry. So the hedging we lose in a loss making position and trailing stop we use in a profit making position. That way can book profit on the upside. In the event if the hedging is making profit, after the hedging is filled, the hedging continuously make profit for 30 minutes and more, then you understand they are making an intentional move on the downside. So intentional move, they will make up to 150 pips net change on the downside. So in such a situation, what you can do is close the buy position with 40 or 50 pips loss and gain about 100 to 120 pips. In the case of the hedge, you make a net profit of 50, 60 pips at the end of the day itself. So if you have the trading strategy, even if the forecast goes wrong, you still make money from that other market. Isn't it better? So that is called either way trading. There are other innumerable varieties, innumerable methods of trading which are beyond the scope of the webinar, because I give it during the professional trading training, what I give it to my members. So I will not be able to give it here for free. So you should excuse me. But at the same time, I have given you for small traders the basic ideas, how exactly you can go about. You can use your own applications. You can use your own common reasoning out and common sense and develop the trading strategies and try to make continuously money from the other market. Now coming to the trading. So it is supposed to be the early European session trading. That is around 8 GMT, but now it is 9:40 GMT. It doesn't matter. Still, we'll take the position and probably come to that of the editing mode. Only then I'll be able to enter the trades. So Euro is around 1.114849 now. As I told you, they are likely to make a dip as a false move before making a rise. So we'll keep a buy limit order 10 pips below the market. $1.1138. And our hedge order will be a sell stop 30 pips below 1.1108. Our exit order, that is take profit, will be about 75 pips above that of the entry, because the market is likely to go up after that of the FOMC or even before that. So we will keep 45 to 75 pips as our target, and we will use a trailing stop once the position start making profit, and we will keep 75 pips as the exit order. Either a trailing stop or the exit order will be filled. So that will be 1.1208. Then in the case of yen, as I told you, that they are likely to make a drop. See, they have come to the initial low now, 101.52. As I told you, that they are expected to come down. Now they are handling euro yen on the downside, dipping euro, dipping USD yen. In the absence of big volume in the majors, they make such contrarian moves and drop. And also, you know that Euro GBP cross, wherein Euro is in negative net change and GBP is in positive net change. As a result, Euro GBP will come down because the denominator is stronger when compared to that of the numerator. So they're able to bring down Euro GBP, see here, by 2 pips. So this is how they handle the majors and the cross, the majors by which the moves happen in the crosses. So that you should be able to understand. And it is being explained to many of the traders other way because of big moves happening in the case of crosses. The majors are making the moves of that nature. That is how they always try to give a wrong information to the other traders. Similarly, they also say that now Dow Jones is going to rise, or Dow Jones is showing positive net change, and it is likely futures is showing that it is going to gain. Then immediately say that, oh, in that case, euro can also rise. There is no guarantee because the charts might look similar, but there is no guarantee. When Dow goes up, there is no need that euro should also go up. But the players can give different story for the stock market to that of the currency market. Sometimes you come across when Dow Jones goes up, that US euro might go up. And certain other times, there are many occasions wherein they said when Dow Jones go up, USD yen also goes up. That is how they go in the interpretation. So from time to time, they will just find the coincidences in the chart and say that they are all correlated. So don't go with such studies, especially they are all misguiding factors. You need to read the intention because the players handle euro differently from that of GBP. Even though they are all currencies, they handle euro differently when that of GBP. Euro is in positive, negative net change, and GBP is in positive net change. If you correlate that when euro is coming down, GBP has to come down, then there itself it goes wrong. And USDN, as I told you, that they are likely to come down. So 101.08 is the new low. We'll keep a buy limit order at 101.08. Then exit, we'll keep it near that of the high 102.78. And our sell stop 100.78. About 30 pips below, we'll keep the hedge order. So I just given two cases. And what about an Australian dollar? GBP I'll give 1.2991 is the current level. I'll keep 10 pips below. The buy limit, nothing but fine tuning our entry. 10 pips below that of the market. We keep a buy limit order 1.2981 with the sell stop 30 pips below. $1.2961 and exit. They are likely to gain in a big way to 1.31 to start with. Okay. In the case of Australian dollar, buy limit, as I told you that they gained the level 0.75. 60 is the initial high. We'll keep it as 65 as a buy limit, 5 pips above, because they are likely to give a quick dip and then gain. At the time, if you get fine-tuned buy, it will give good profit. then our exit will be around 0.7670, and our sell stop 7535. So these are all the trades we had decided. Depending upon the type of move they had done it, slowly you come across euro is making a dip, GBP is making the rise, and they are trying to handle euro GBP cross and also making a dip along with that of euro USD yen in order to make a downward dip in the case of euro GBP. And along with that of euro, they are also making a dip in the case of USD yen, negative net change, that is euro CH. They are making a downward dip by making a contrarian move. And in the case of commodity pairs, they are making the USD weakening more strongly. Whereas euro is making USD gaining more. Yen is making USD weakening more. GBP is making USD weakening more. And CHF is making USD weakening more. Then Canadian dollar and Australian dollar are making USD weakening more. So this is how they make the contrarian move to handle various crosses. Keep that in mind so that we'll be able to really understand. Okay, having understood the trading, what you can do next? You come across a competition, a demo context in FX trade. A demo Forex trading context is going to be there in the month of October. More details are given under the heading context. You go to main homepage in FX Trade, you find in the main header menu, the last one being context. Then you click that, you come across the registration form to register for the context and try to do it in a demo trading and find out, leave alone the prize money, just participate and see how far you are able to succeed in a trading. Because these are all the things we can make use of it for your learning purpose. And I strongly recommend traders to go in for a demo trading. Let them do it even for 2 years and 3 years and try to learn the art of trading and try to learn the intricacies in trading. Then later on, if they come for the real trading, in any account, they'll be able to really make good money. So for that, demo trading is vital. And some people say that I was doing very well in demo trading, and when I come to real trading, I'm not able to do it in the same way. The main reason is in a demo trading, they give at least 50,000 as your equity. So you don't bother about the equity, and also it is not real money. So which is not giving the real fear. But when you come to that of the real trading, your equity might be very less. And in the process, even if there is a small drawdown, you know that really you are going to lose that money. So the fear grips in. That is why you come across variation with regard to the demo trading and the real trading account. But to get rid of it, what you have to do is use the risk limiting factors. So you know very well, speculation invariably leads to risk. There are different grades of risk. The low risk, medium risk, high risk. High risk, you go in for high leverage trades, like 1:200, 1:500, etc. of taking the positions. And that is very high risk because the platform providers give you enormous position for a single small quantum of equity. When enormous position goes against you, the drawdown is also very big. You don't realize it. You think that if you pay $50, you're able to take one standard lot. You think that it is a great platform. But when the position goes against, when the market goes against your position, the drawdown for the bigger quantum of position will be much bigger and your account will not be able to hold it. So please visualize all those things and understand a platform wherein they offer the less leverage will be very conservative, but which will also give you lesser drawdown, and also you will be able to trade and earn. But if the drawdown becomes bigger, you have to go in for a crisis management. There is no way you can apply the trading strategy. You will be doing all the time the crisis management, and then you will become fatigued. You will not be able to earn what you envisage. So keep in mind that high leverage trades are highly risky. And also, you take position only for 1/100th of your equity. And if you're using the hedging, probably you take about 2% of your equity, the position, and try to slowly earn it. Slow and steady will win the race. And you can still do it in a mini account. Doesn't matter. And people might say that, what, you are a big man, you are doing it in mini trading. Doesn't matter. But still, you will be having lesser market fear. Thereby, you will be able to earn slowly the profits from that of the market and grow the equity. So growing the equity should be the objective, and you should not get away from that. So if there are any questions, kindly ask me in the question answer window. I'll answer to those questions. I'll be giving the part 2 of the webinar between 14 and 15 GMT today during the US session. And also I'll give you the call before that of the FOMC, how the market is expected to behave, so that you will be able to go for another trade. If there are any questions, kindly ask me. These are all the orders I have kept. You can make a note of it. And I will come back during that other part 2 of the webinar and show you the results of these trades, what happened to the market, so that you will be able to understand what I say I practice. It is not that I say something and do something else. So if you've got any question coming on mind, kindly ask me. I'll explain to you. So this is the market timing slide. And also I have given the important functions, how the players are handling it. You can go through that, take a screenshot and read it. Otherwise, the webinar is being recorded. You can listen to the webinar and note down all the points and follow them carefully. You'll be able to really progress well in your trading. Because I'm doing it as a mission, and I want the small traders not to lose continuously money in the market. So I'm trying to help them by giving such informations. So don't think that I'm controversial or something like that. My main objective is to help the small traders not to become victim of the market sentiments, and let them earn money and get away from the other market. Big players or big traders can continue to speculate and do trades, and that is a different matter. But small traders, when they find it is very hard, and even $100 become very precious for them, and they simply come and lose in single trade or two trades, it is really painful for such people. And I wanted to address the pain of such people. That is why I'm taking so much time explaining all those things. So focused on derived forecast, market reading, and the trading strategy. I don't come across any question here. There are two conditions. If you are able to understand fully all the concepts, then there won't be any question. Otherwise, if you are not understood anything also, there won't be any question. I don't know to which category it belongs to now. So slowly they are making the dip in the case of euro. Slowly they are gaining the level in the case of GBP during mid-session, and quickly they will make a knee-jerk reaction after handling the crosses. They'll come to the majors. At that time they'll make quick moves and then reverse the market. During such quick moves, we should be able to capture the positions. So always when they make a quick drop, stop cutting the new low for 30 minutes to try to take a buy, you'll find that stop will not be filled. Instead, if you go in for a strong supports and the resistance and calculate the resistance or calculate the supports in various methods and try to find out, okay, I'll try to take a buy there. And after taking the buy, you might find that stop is being filled, because the players know very well where the traders are taking positions, and they earn money only by hitting the stops of such traders. So they focus on the stops. In such a situation, there's no point in calculating the supports and the resistance. You have to wait for them to set the low, not cut the new low for more than 30 minutes. Then they are unlikely to cut the new low. Then if you take a buy, we'll be able to really able to keep stop at entry in the position. Thereby you will be able to eliminate the risk of losing money. So these are all the orders. So no question is coming forward again. So there is going to be a context in FX trade, a demo trading context, in which if you earn maximum money in a specified time frame using your intelligence and using your market reading technique, then you will be rewarded. More than that, so you'll be able to identify a time frame and try to focus on that and try to see that you are able to compete. Competition give you certain amount of trigger for you to earn more, and also use your trading strategy appropriately, not to lose money. And you'll be able to do the money management as well in order to compete in that. It is not the number of trades, what you do is matter much. It's a question of how much of money you earn in a demo account, doesn't matter. So how much you earn in the market is vital. So then that will give you a passion for you to earn more money from the market rather than just simply taking a position and become addicted to trading. Simply say that I'm holding euro position, where exactly it can go up and can it go to 1.40 and things like that. If you ask, then it is nothing but expectations, and when it is going to be met with, God only knows. So don't do such trades. Instead, you try to see that visible profits are being earned from the other positions. And many people say that by simply holding loss making position, they say that I'm doing position trade. That is wrong. When you are holding loss making position, it is not at all trading, because you are simply holding loss. So if you are holding a profit making position and try to maximize the profit using the trading strategy of trailing stop and trailing limit order, then it is appreciable. So try to minimize the loss and maximize the profit. That should be your objective. So questions are not coming forward. So I'll wind up the webinar now. So close the windows. I take this opportunity to thank FX Trade for the facilities provided to present the webinar. And those of you who listen to the webinar might be able to understand how trading has to be learned as an art, and what are the intricacies you need to learn so that you will avoid committing such mistakes. And especially in trade, if you commit mistakes, it becomes costly mistakes. So avoid it. And I'll come back by 14 GMT for part 2 of the webinar and show the results of the trades what I have envisaged, and also give you the trade call, how exactly the market is expected to behave for that of the FOMC. So wish you all happy trading. Try to get rid of the market fear by having a perfect understanding of reading the intentions of the players. See you by 14 GMT.